Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Well, welcome everyone to Vantage Point with True North Wealth Partners.
All right.
I'm Andy.
Eric Susi.
Number 47, Tuesday, April 22nd.
April 22nd. It's springtime.
Made it through tax time, tax
Taxes,
day.
Easter, birthdays. It's a lot going on.
Yeah, no doubt. Yeah.
Good.
You been golfing yet?
Yeah, right. It's been a few years. They're collecting dust.
Yeah, right.
Doing all right? Family good? Hanging in there?
Yep. Doing well.
Good. Well, lots has occurred since January in our last...
Smack me around.
Man. Well, we got a lot to get into here, so let me maybe just start with the disclosures so we're all good for compliance. So basically, anytime we're holding up anything, basically, information has been obtained from a third party, sources which we believe to be accurate. We cannot guarantee its accuracy or completeness, though. However, if we talk about asset classes, prices, things like that, diversification, the following information is general information only. It's not intended to be specific investment advice. It's important to consult your financial advisor who understands your individual financial situation prior to making any investment decisions. Lastly, more importantly, is our beliefs. What we say, it's our opinion. We believe has nothing to do. This is Andy and I show, okay? It's nothing to do with anybody else. So that's all of our beliefs, what we think is happening. What's happening? Hot stuff? That's a good movie.
It is, yeah.
All right.
16 candles?
Yeah, something else. All right, what's the latest? What do you got going?
So we had the election. We had since last time, right? We had the election. We had new course of new year. We got a lot of volatility with the stock market.
Run down,
and all that. And other than that, the normal life stuff, right?
Exactly.
People retiring, everything.
I hear you. Well, let me just sort of set the table, I guess, sort of what happened since January, our podcast for this year. So spot on. We talked about as far as market valuation and market volatility here. So it's basically down between 8-12%. The S&P, we were close. It's down a little bit more than that, but remember the averages are at least you're going to have a couple of those downdrafts of at least 5% or 10%. So we hit that. More still to come in both directions, as we've seen. It's volatility. So I'm just going to point out a few things, sort of setting the table. So you've heard, and this is from First Trust and our man, what's our guy's name?
Brian
Westbury. Yeah, Brian Westbury, phenomenal. So he puts out these great informational sheets. I'm just going to refer to that. Our producer Nathan will hold that up for you. I'm just going to highlight and just read a few things. So, Federal Reserve Atlantic Feds put out forecasting for the Q1 GDP. So, they are saying like negative 2.2% Q1. To the contrary, they, meaning First Trust, is predicting Q1 GDP positive 0.3 tenths. So 0.3 tenths. So just call it flat. Hedgeye, the other research center, and a lot of other firms we use, again, flat. So what I'm trying to say is we do not see it being dramatically down 1, 2, 3, 4% at like other people are talking about. And even if it is down, it'll be short-lived, in our opinion. Think back to under Biden and Yellen back in 2022, I believe they had 2 consecutive quarters of negative GDP, but they did not call that a recession, even though technically that didn't meet the definition of recession. So the goalposts did move. And even if we have a bad month or a quarter of a negative GDP print, it will be short-lived in our opinion, at least what I see and read. What's your thoughts on that as well?
No, I agree. It moves so fast. It's like, who cares? I mean, not who cares, but it's just like by the time you hit a recession or out of a recession, they said, well, we had a recession. Yes. It's just, I mean, unless it's like, what was the last real significant recession? 08, 09.
Significant, that 18 was quick, 22, quick one. Those are quick. But we had pullbacks and, markets are down 15, 20%, but, they don't last forever.
Yeah.
So I just wanted to point that out, year to date, again, a lot of the market watch gets produced. This just came out, from that on a weekly basis, but just highlighting a few things. The EFA is international, so that's been positive, up over 6%. Bonds have held up. So finally, they've had a couple of years of not adding any alpha or helping, but now they are adding some return. But other things, and Russell was small caps down over 15.35. This is year to date through last Thursday's close. So just mentioning that S&P was down, almost 10%. Dow was down, 7.56, things of that nature. So I just want to keep things, it's all relative. Our models, we're holding up okay, things of that nature. I know I've done my rebalance back in mid-February at the highs, put on some defensiveness. I know you've been tweaking things as well. So so it is what it is.
That gold's had a big run, hasn't it?
Yes. All that gold.
Bitcoin.
Yeah. Finally, Bitcoin's it's dislocated. Finally, it was mirroring the markets. Now it's opposite. So which is good.
That's the way it should be.
Yeah. Oh, and then again, going back to Brian Westbury, again, I'll just hold this up. This is an article that he published as well, talking about, where are we fair market value wise, GDP, things of that nature. So, he's right more often than he's wrong. And we talked about this in our first episode in January of this year, how he came out. He was the only one of the 20 plus economists saying, hey, S&P 5,200. And, he looked out there on an island by himself, but he was right so far. So again, they are still holding on to the forecast of roughly 5,200, but they're still having a more cautious outlook. So, S&P's bouncing around. We're basically in a trading range, 4,800. Let's call it 55.21 is sort of the range of the bands of where we're at. So we expect that. I personally anticipate more headwinds. May should be another draft month is what I anticipate. Hopefully retest one final time, and then hopefully that's it. So nothing, not straight up, but as far as I retest, because again, I don't think the Fed's going to cut in May at the meeting, but a lot of pressure is, and a lot of pressure is showing that they should, but they probably won't. But they probably will at the June meeting. So going with the Nowcast, again, this is Hedgeye, and Hedgeye produces this on a weekly basis. This is their Nowcast for CPI. So again, and Nathan will hold this up, but it's awesome. So they're spot on. And Stratus Investment Management, they use this as well. They've been getting this information. So you can see the low point of CPI was down to 2.44 back in September, and Hedgeye was the only one that's been accurate. They've called it, and they said it would be hit north of 3, hit 3, came back, reverse engines, boom, 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 went down. 2.39 was the last Nowcast. Now the one coming up for April CPI that will be released on May 13th. They're calling for a 2.31. Could be slightly higher, slightly lower, but the average that they're pointing out is 2.31% as a CPI. So, okay, down, great. Then you're going to start seeing it go back up. So sorry to tell you, folks, but it's going to go higher, okay? Not 8 or 9% like years ago, a couple years back. It's going to be north of 3. So the 2.31 will go to 2.5, 2.75, 3, et cetera. So we'll go up in that 3% range, but nothing crazy. We've seen it before. It's not our first rodeo. So just giving you a heads up of what is to come. In addition to that, monthly quads. So basically, again, these are just the monthly quads that Hedgeye does produce and put out. So I do want to point out two things, July and December. July and December have 2 quad 4 months. So it could be, again, what we've seen in February and March, some choppiness. The rest of it's going to be quads 2 and 3. So remember, quads 1, 2, 3, 4. Quads 1, euphoria, springtime, everything's great. Quads 2 is summertime, still growth, good, okay. Inflation's still high. Quads 3, the economy's slowing, inflation's elevated, sticky, okay. Quads 4 is batting down the hatches, lose less. That's what we have been in for the February, March, and part of April as well. So what I'm getting at is, so I just we're going to be bouncing around, no clear like trajectory for a while. So just wanted to hit on that for you all. So a couple other little things and factoids. Total foreign holdings of U.S. equities, treasuries, and debt. So Nathan will punch that in so you can see it. So this comes from the Federal Reserve and Apollo chief economist there. Basically, so U.S. equities, about 20% of total, roughly it's 18, yeah, they're around, 20% of total equity market is U.S. equities that foreigners own, okay, by holdings. Next is treasuries. 30% of total treasuries is held by foreign ownership. And then corporate credit, again, 30% of corporate credit is held by foreign entities. And this is all in trillions of dollars. So equities is 18.5 trillion, treasuries is 7.2 trillion, and U.S. corporate credit's 4.6 trillion. So we gave you the dollar amount and the percentage amount held by foreign folks. And then
I think it's Japan. Isn't Japan in number one?
No, Japan and China. Yeah.
Between the two of them.
Yes. And China has been deleveraging, but that's correct. And this is rate of change, again, by Hedgeye. Nathan will punch in on this one. This is cool. Highest corporate profits ever. Okay, this has been tracked since December 1970. So basically, just U.S. aggregate corporate profit margin, all-time high, ended the year December at 13.5% is all-time high for corporate profits. This is the K-shaped economy, the K, have and have-nots, okay? So that's what we've been in, artificially propped up by the government, M2 money supply. I call it the morphine, coming off the morphine. Got that from Brian Westbury from First Trust. What does the economy do? You go through shakes and shivers. That's what we're doing. We're deleveraging. No more Christmas every day, if you know what I mean. So we're getting back to true economics, supply and demand. So it is painful, but that's why we have actively managed things and positioned you accordingly. But anything you want to add on?
Yeah, no, well, just looking over, of course, with the tariffs, looking to seeing what, stateside, what does that mean? Like what in Ohio?
What's Ohio? Yeah, what do we have there?
Yeah, so Ohio is 22% of our economy. Well, we get imports.
Okay.
On the import side, and exports 35%.
Oh, we export a lot more than I thought.
Mainly it's actually Canadian.
Okay.
Yeah, so Ohio goods. So 35% of the goods manufactured in Ohio go to Canada.
Canada. Okay.
Yeah.
Gotcha.
So the largest Canadian, let's see, I was trying to just add it. Michigan's 38%. Mm-hmm. West Virginia, actually, 41%.
Wow, West Virginia?
Yeah. Sweet. The number one exporter.
Oh, that's cool. I'm trying to think what that could be.
Yeah.
Maybe it's coal. I don't know. But anyways, okay.
Yeah. Yeah. And then percent of overall GDP, state GDP relating to imports is export-import activity, 15% in Ohio. So Tennessee's 40%, Michigan's 35%. And I was surprised. So like Hawaii is only 3%.
Yeah.
12% is Alaska. So yeah. So just kind of interesting thinking about how it does impact us locally. But yeah, it's.
Well, I mean, just to put a bow tie on that, just summarizing big picture stuff. So last time, like the economy, I call it drain the swamp, has occurred really 40 years ago when Reagan was in office. So that first year, just to remind folks of what happened, the stock market was down for that first year, okay? Then it was up for the 7 years thereafter. So just keep things in mind. And again, Trump coming in, making changes again. So, okay, yeah, you got the Doge out there finding the waste, fraud, and abuse. And I knew there was a ton, but I didn't realize there was that much, but there's a lot out there. So that's good. You want to, that's our taxpayers' money, reclaiming that. But in addition, just resetting the trade. So that's adding a little more spice to the ingredients here. So that's what's creating a lot of volatility. But people will come to the table. And again, just want to reset that. For good, bad, or indifferent. So short-term pain for long-term gain. That's for all of America. So just hang in there. Again, we don't anticipate a recession, just a lot more volatility, bear market, short-term, things will be condensed, and whipsaw like we've seen is what we have talked about and seen.
It's overdue.
Yeah. Oh, yeah. They can't keep this artificially economy propped up by the government and spending for all these years. So we're coming off that. Tips of the month. Want to get into that?
Sure.
All righty. So let's start with electricity. So this is pretty cool. Electricity here, again, Nathan will pop into this. So this is all some key top economies. And where are we here? So India utilizes coal the most. I'm going to round it up to 73.4. Okay, so there you go. That's coal. China is 58.4%, okay, of the economy relies on where the power come from is coal. The United States is only 15.6%. Okay, so we've come off that. It used to be over 50%. So we've come off of that. You see natural gas has surpassed that. It's 42.6. We're going to see nuclear at 17, almost 18%, and that's going to get greater and greater as well. EU is only down to 10.7%. And then you have global, all the other countries abroad. So this is as of 2024. Again, fossil fuels, how that's made up of the world's power generations. I thought that was a neat little article. This is your favorite, huh? You've seen this before. Right. Yeah. So Andy, man, this is coming. Oh, and this is all from a Visual Capitalist. So that's who produces these. This is the best places to work. So over the years, they rank them 1 through 15. So over the years, it's interesting though how some have stayed with it. Bain, Crew, In-N-Out, NVIDIA, MathWorks, things like that. You can see the lines.
True North.
Yeah, True North's in there. Yeah, there you go. So yeah, we're at the bottom, but yeah, we're there. Right. But Bain Capital is interesting because we're familiar with that name, right?
Yeah, they're private equity. Right?
Yeah, PE, private equity firm. So they look for consulting and helping entities, fine tune their businesses. So I just thought that was an interesting place. And this is coming from like Glassdoor. And you speak to Glassdoor because I know you taught me about Glassdoor years back.
Yeah. I mean, it's just an employment website. But you can, if you're an employee, you can go and leave a review about your employer.
Right.
Whether you're working or you left and moved on, you can go back and kind of review the company and so it gives people, if you're interested in a job at a particular company, you can go to that and see like what's the culture like, how do they treat their employees, how they rank as far as pay and bonus, benefits, that type of stuff.
Yeah, it's a good site. So I thought when I came across that, that'd be something. And I was thinking of you, it's like, this is Andy, man.
Yeah, that's right.
And then this is sort of interesting too. I'm just going to speak to this, but this is part of our research that we use, Tier 1 Alpha, and Mike Green and their crew there. They were just talking about yesterday, was Monday, okay, so how the markets were down that day. But what was interesting is because of Harvard and Yale, they have some of the biggest endowment funds, but they have a lot of private credit. Private credit is what they have for their endowment fund. So it's not easily liquidated per se. So they were just talking about, hey, yesterday they were talking about how Harvard might be starting to sell what's liquid in its portfolio, the stocks and things to help out. So they're just researching that. And Harvard's highly leveraged to its PE. It's close to 40% of its endowment's leveraged. So it's just interesting how other firms are allocated into that. So I just wanted to touch base on that.
Yeah, but West Virginia, they got to be exporting coal.
Yeah.
To India, right? China.
Everything.
Either that or toll roads. Can you export toll road, toll booth?
Yeah. Right. So with that, all right, let's go ahead and end on charts. So this is just a recap. So
I'll take my nap.
I know this is all good, but it's put things in perspective. And it's really pretty interesting to see how things fly and move around here these days. All right, first one here, stock market performance. Now, this is through yesterday's closing price through April 21st, year to date. S&P is down 12.3%. So you can see ups and downs, the ebb and flow of it all. So it is what it is. Stock price to PE ratio. So again, this was nosebleed. It was like close to 24 or so on the PE ratio. Now it's at 19.7. And again, this is as of April 15th, last updated point has been updated. So you want to see that come down, things that get more evaluated correctly, more in line of the national average there. Historical average is 15.8. So 15.8. So, if it gets closer to that, things are then undervalued, then you can buy and markets go up again, things of that nature. This is pretty neat too. Valuations, today versus a year ago. And this is like standard deviations, 1 or 2 point standard deviations up or down. So basically, today is the little diamond shape versus 1 year ago is the red little X. We're pretty much on top of that. So we're still elevated in the normal ranges of the boxes. So again, that just tells you, even with all the market valuations up and down, we're still elevated. So that's why I don't think we're quite out of the woods yet as far as this, volatility. Volatility, speaking of the VIX, 30 days going out in the CBOE, Chicago Board of Exchange, So again, we hit basically last week, you saw VIX hit over 50. And now as of yesterday, it was 33.8 and historical average is 18.4. So just a recap here, folks. So anything less than 19, any fool can make money. Throw a dart in the wall, you're going to make money. Once you hit 20 to 29, that's called the chop bucket, up and down, the chop. And once you hit over 30, I'll leave it at this. It's called the F bucket. You can use your imagination. And that's all coming from Hedgeye. But anyways, so you don't make money, and it's about losing less. So that's crazy times. Bond market volatility, again, when I was at T. Rowe there, I focused in on that because the bond market, the VIX, called the MOVE Index, is the VIX equivalent to the VIX on the equities. It spiked up to basically like 140 right now. As yesterday, it went to 129. Historical average is 87. So it got pretty complacent there, a few months back, and now it's spiked out. So that's a leading indicator. Okay, when they blow out the credit spreads, the high yield and corporate, strap in. So that's what that's about. Stock market pullbacks, we talk about 5%. On average, you have 4.6 pullbacks a year. Right at it, right at 5. We already hit 5% pullbacks in the S&P and already. This is through yesterday, our data points April 22nd. So there you go. 10% pullbacks in the S&P. Okay, the average is 1.2. We've had 10% pullbacks in the S&P. And we said that in our January podcast. I expected it, and we got it. So there you go. So it is what it is, but it's part of the investing. And then all-time highs this year. So we've had 3 all-time highs in the S&P 500 index. That was obviously right there when I did my rebalance, right at the market highs in mid-February. That was, that's when you hit in January and February, the all-time highs 3. And you can see the S&P correct straight down. But typically, once you hit highs, you continue to have highs. So we'll see if we can get back to all-time highs by the end of the year. We'll see. Fingers crossed. I wouldn't hold my breath if we're gonna, but if we can just get back to north of 6,000 or so, that'd be lovely. The S&P 500, trailing 12 months, the growth historical average has 7.7. Right now, it's still elevated. It's at 10.1. See, these earnings, this is why the forecast, the earnings growth, these analysts need to bring down their guidance. So they brought some down for Q1, but forward guidance as far as second, third, fourth quarter, they need to bring them down. That will then bring down the growth rate as well and get things in perspective for the next leg up. Right now, things are still elevated and it needs to be brought down. So that's why I don't believe we're out of the woods yet. Yield curve, the 2 10-year steepness. So we're at the highest spread as of yesterday, 0.67. So the 2-year, 10-year spread is 0.67. The average is 0.85. So you can see we've been inverted. That just means the 2-year is providing more yield than the 10-year for over 2 years or about 2 years. But they didn't call that a recession, but it's just one of the indicators. But anyways, when you come out of a recession, that's typically when you do have that. So we'll see if it all lines up. If you do go into this bear market turns into a more defined one or not. Leading economic indicators over Conference Board, there's like 15 leading economic indicators, been negative for over 2 years, still negative. So again, we'll see if it all comes to roost. And if we do, this bear market does go into a recession, it should be short-lived. Unemployment rates been roughly around 4%, went to 4.2. Remember, I believe I said in the January podcast, I said I expected to go to 4.5. So that should be north of 4.5. I'm hearing more than that. Danielle Martina Booth, another person I follow, she's awesome. She sees that north of 4.5. So when you have dislocation there, again, this prolonged unemployment will tick higher is what I'm seeing. Payroll gains still hanging in there. 228 was the latest. Okay, great. So historical average is 120,000 jobs, payroll gains per month. So as long as we're north, that's called the average of 120. That's a good thing. Consumer spending still hanging in there. A lot of the consumer spending, has occurred sort of front run, trying to get in before the tariffs. However, those fall out here in the next few months. CPI again it can spike up near 10, over 9. Then it's gone down. So the core, which excludes food and energy, you can see it's 2.8. And then the PCE, again, PCE that's the preferred measure from the Fed. They want that core PCE, which is 2.8 as well, to be down to 2%. They're not going to see that. But my point is it's going to, like I said earlier on, I anticipate another month of lowness and then start to go a little bit higher, right around 3-ish in that range. And we'll go from there. So we covered a lot. More volatility. Hopefully, after as we get through summer. And again, the market's always front run what happens. So that's why I'm anticipating things to get a little bit smoothed out as we have more clarity amongst everything. But that's, we have a right position built on for our models and what we're doing there. And then we'll get more aggressive at some point and we'll go from there.
Yeah.
All right. Anything else? Is that it for now?
Oh, sounds good.
Go get your clubs. It's sunny out. Right. Oh, it's going to be 80 degrees tomorrow.
Yeah, that'd be nice.
That's good for Ohio weather.
Yeah.
All right. We appreciate y'all, folks. Reach out to us. Any questions, concerns, in-person reviews, phone reviews, webinar reviews. We're here for you to help you navigate. I know it's not fun going through this, but this too shall pass.
That's right.
We appreciate you. You take care and happy spring.
See you guys.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. Opinions expressed in this podcast are for general information only and are not intended to be specific investment advice. It is important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. Some of the information contained herein has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. The information should not be regarded as a complete analysis of the subjects discussed.